Welcome to the show. So I'm here with Chris Shebib, and he's an investor-focused realtor, speaker, podcast host. The list goes on and on and on. Award-winning real estate investor. He also presented recently at the Cashflow Recharge event, and he's got over 20 years experience in real estate. He's experienced real estate bubbles, recessions, corrections, all types of stuff. So Chris, introduce yourself to our audience, what you do, how you support the community, and let's go from there.
Yeah, sounds good. Well, first, thanks, Sam, for having me on. Really looking forward to this conversation. Yeah, and happy to, and in the introduction, I'm happy to augment that a little bit. So I've had three careers so far. I started as a contractor, then went into technology, lived and worked in Silicon Valley for a number of years. Moved back here, did more technology in startups and large enterprise companies, which really is one, it's an interesting path for me to have taken. Not the fastest path, but an interesting one. And it really does help in what I do today in terms of everything I do is forced appreciation. And on top of that, I do a lot of, as you mentioned at the Cashflow Summit, do a lot of financial modeling and business case building and strategizing for myself, but also for our clients. So I work in the Northwest and east of Toronto, which is also where I invest. And I do, what could loosely be referred to as Bill 23 properties, meaning changing single family homes into duplexes and now third and fourth and fifth units. And then same forced appreciation, just different methodologies in apartment buildings in all three markets. And that's also where I help guide and consult with other investors and helping them achieve their goals. So I've been training and educating investors for a bunch of years now, just in terms of listening very well. Where are you trying to get to? What are your goals? What are you really trying to accomplish? And then the gift and the curse of real estate investing is that it's not a one size fits all. There's a number of different strategies that are available to investors. And that's great, right? Because your goals should be matched with the right markets and the right strategies in order to get there as fast as you can. The challenge investors have, though, is a lot of options can create a lot of burden of education, a lot of sometimes mismatched strategies with goals. So that's really where the consultation comes in, is trying to make sure that we've got the shortest path in between A and B.
That's amazing. I love that. So when you talk about key success for investors, you're right. I mean, there definitely is a lot of a consultative approach. You're kind of creating that bridge to get them to their destination, understanding what's important to them. What are the key factors of success for investors, especially also with goal setting? Like, what do you do to really understand where they want to go and how to be that bridge for them to get to that destination, you think?
Yeah, it's such an important thing, and it's conceptually very straightforward, but in practice very difficult. So one of the first things is to identify your goals. Again, very well known, very easy to say, trickier for many to do, especially newer investors who haven't really had the curtain pulled back in terms of what can real estate investing do for them, and um, and then reimagining what their goals might be. And so setting your goals is really important. So the comparison that I use often is, think of if you talk to somebody about their life goals and they say, well, I would love to be near the mountains and be near the ocean. Say, okay, there's a number of different locations that can achieve that. Let's say now that that's British Columbia for you. Okay. And so that's the clarity, right? You know what you want, you set your goals, and now you know where you're trying to get to. So being clear on your goals is the number one thing. Imagine trying to get to the mountains and ocean and really having no idea of where you're going, let alone plotting a very expedited path from A to B. So again, conceptually very straightforward, but the devil is in the details and in the knowledge of saying, okay, I'm looking for income replacement versus as fast as I can versus long-term wealth. Okay, well, there's a number of different strategies in the market that can accomplish each of those things. So again, the concept is very easy. The practice of implementing that is more difficult. And then the number one thing I think for investors is, as it relates to the goal setting and getting from A to B as fast as possible, is focus, right? The way I articulate this is, most people who are thinking about real estate investing have an entrepreneurial spirit to them. And that's great because we're willing to take a path less traveled in order to achieve an outcome that is often not achieved. So that's awesome. That's the good side of it. The challenging side of it is that we're all, somewhat to varying degrees susceptible to the shiny thing syndrome. And in real estate investing, man, there's a lot of shiny things out there. Again, it's not a one size fits all. So there's a lot of different strategies in different markets. There's different countries. A lot of people talking about different countries right now. And that's all good, except it can really slow you down. The path to income replacement and wealth generation can be very, very straightforward and relatively, I'll put an asterisk on that because nothing is guaranteed and change is inevitable. Adaptation and change are inevitable, but relatively predictable. And what I see a lot is sometimes a lack of clarity and very often a lack of focus that is just slowing people down from getting where they're trying to get to as fast as they can.
Okay, so definitely helping them get clear on why those goals are important to them and those goals as well. Income replacement being a big thing, so lifestyle potentially for that investor. What do you think the biggest challenge is why or that they're not able to narrow things down? I know with real estate, I remember we talked about this. It's sort of like a people collect these ideas and then all of a sudden they have this interest of things that they heard around that are great to do. And now they're implementing all these things at once. What do you do to help someone narrow things down? And if you can provide maybe an example of how you helped someone, that would be really awesome.
Yeah, for sure. So one of the reasons why it's hard to narrow down is the investor community is very good at sharing information, right? I come from a corporate background. Again, I worked in technology for 17 years, which was amazing. I worked with some really smart and bright people, which I loved. But the culture did have an information hiding aspect to it, very different from real estate investing. A lot of sharing going on, a lot of openness, relatively speaking. So I think that's awesome. But it comes with the challenge of investors maintaining focus while they execute. And again, a part of the paradox of being an entrepreneur is you have to be aggressive and you have to be patient. And the marriage of those two seemingly conflicting states, it makes people very susceptible to losing focus along the way, right? Like I have to be aggressive. I want to achieve as fast as I can, but I need the patience and the discipline to maintain focus while I go. I'll give you a good example. I spoke with an investor just the other day, phoned me, was a referral, said, hey, I think, I understand you've got experience in apartment buildings and you're guiding and consulting with clients on how to invest in apartment buildings. And 100%, right? That's absolutely something I can do. And while we were having this conversation, what I was really trying to do is listen and say, is this a good fit for you? That was the question on my mind before we get into a consultation or moving into it or whatever. And it turns out that this investor lives and works in Toronto, really has no desire to get into markets on the peripheral of Toronto, which was where he was being advised to look for apartment buildings. He was doing Bill 23 stuff in Toronto, right? And as I spoke, consulted and asked, and really just tried to listen, ask good questions, listen really well to what he was after. It turns out that the apartment building, especially on the peripheral of Toronto, was really not a good fit for him. So it was a great example of, and this is something that I see a lot in the investor community. It's often perceived that you're going to, as a beginner, you're going to do residential, and then when you get more advanced, the next evolutionary step is multifamily. And I really try to reposition that in investors' heads and say, it's not an immediate evolution or graduation that you're looking for. For a lot of people, that residential investment, one, is very, very strong in terms of its potential and its wealth building capabilities. And two, operationally is very different from apartment buildings. And so there are times and places where apartments are the next step or the first step or the next right step for investors, but definitely not always. And it's really, as is always the case in these, I find, is it's a matter of, there's option A, B, and C. Each one has its pros and cons. There isn't a right or a wrong or a good or a bad. Pros and cons. My job is really to offer the best articulation of those pros and cons and match it with the investor's goals. Again, so that they really build the business that they want to own in the end, right? Because it's very easy to build a business that in the end, it's like, okay, I was hardworking and I had the good fortune to be successful, but I don't actually like this business and I don't want to own it. Right? So, we're going to do all this work. Let's make sure we're getting to a destination that we actually trying to achieve.
That's a great point because it almost reminds me of someone just creating another job for themselves or either a high income job or getting a franchise where they're creating more systems in another job. So what I'm hearing you say is it really you're helping match their lifestyle and their desires and how their profile is, what they're actually suited for based
Yeah.
on the conversation versus what they're told they should like to do, rather multifamily. And it's not just a graduation of single residential to multifamily. So it seems like you definitely take a consultative approach to helping your clients, whether they're starting out, whether they're getting a few properties. I know you talk a lot about the history of real estate, why real estate is still a good asset. Just wonder if you can touch on that, and also that numbers, more doors and things are not necessarily the answer. Because I know you talked about that in your presentation with 4 properties, how that could really be a big difference for someone. So,
Yeah,
um,
yeah, yeah, for sure. Yeah. So again, part of the benefit of invested for a number of years, I've seen a number of corrections. And although I was very, very young and wasn't actually investing in the correction of 89, it was one of the biggest that we've seen in the last 50, 60, 70 years. So what I did was I went back and I did an analysis on the correction of 89 and really tried to prove or disprove the old real estate adage that you shouldn't time the market, you should spend time in the market. Meaning buy good properties, hold good properties, build wealth doing that. The old adage that it's time in the market, not timing the market. And so really looking at the correction of 89, and this is another thing that's very important throughout, study all these corrections, study the data, never make macro decisions from micro data. Right. And so if we're going to make big strategic decisions, should I invest? Where should I invest? How should I invest? What strategies? Use macro data to make those decisions, but don't look at same sentiment from 2 years ago as is today. Interest rates are a great example. Don't look at one variable in a 10 variable equation and govern your macro decisions based on that. That's a good example of making macro decisions from micro data. 2 years ago, the pitfall was rate chasing, right? I want the lowest, cheapest rate. It's like, hold on, not always the win. You would be better off to position yourself for a slightly higher rate in 4 properties than you would for the very best rate in 1 property. So, think broader than that when you make your bigger, more strategic decisions. But, getting back to the correction of 89, improving or disproving this adage about, time in the market versus timing the market. What I did was I mapped all the market appreciation data throughout that time period. So it was 6 years down, 7 years back up to achieve the same average purchase price in the market. So a 13-year correction, one of the biggest. And what I looked at was in 89, at the peak of the price, if a person was to purchase there versus they had a crystal ball, which nobody does, but if they did, and they waited the 6 years to the very bottom of the market, fast forward 15 years from 89, who makes more money, the person who timed the market or the person who spent time in the market? And the data is clear. The more wealth was built by the person who bought at the quote unquote worst time in the market versus the person who waited the 6 years and bought at the best time in the market.
wow.
Yeah, exactly. Right. And that's because there's more components to wealth building than just market and average price. Right. And that's so important for investors. When we get barraged with headlines in the media, it's almost always either partial misleading data or just average purchase price, not the holistic picture. Right. And so very, very important as we look at this. And it's the same thing today. Right. If you rewind to 2008, where there were corrections, especially in the US, but also here, a lot of people made a lot of money by investing and doubling down in 2008 rather than waiting until the market was picking up further and further and further. And it's no different today. If you compare the buying experience of today versus 2 years ago, I mean, you're never going to get all conditions to be perfect. You're going to have ebbs and flows, but there's an expression: every day is a good day to make a good deal, right? And no day is a good day to make a bad deal. And so when the market's changing from 2 years ago till today, very, very different conditions, but good deals are good deals, and they're going to pan out over that 5-10 year time frame, so long as you buy and position them well, which gets back into your second part of the question of, this presentation and the 4 properties I'm talking about. It's another myth that I really try to dispel, and kind of sentiment in the investor community is, well, I hear people talking 50 doors and I hear people talking 100 doors. And that's great. There's nothing wrong with 50 and 100 doors. There really isn't. However, it is not the heart of what you need to do in order to be successful. In fact, be careful of the business that you're building, because 50 and 100 doors is a big operation, and that might not be the business you're trying to build, let alone the idea that it's not necessarily a critical path to building income replacement and wealth generation. So, what do I mean by good deals? Every day is a good day to make a good deal. For me, there's a component that is very underestimated in investing, and that is the component of what control do I have over this asset. And again, it's not right and wrong and good and bad, but pros and cons and very important variables and weighting of variables is how I describe that. So for me, it's what has me steering clear of pre-con condos, for example, and emphasizing more in Bill 23, because Bill 23 can set an investor up, purchase properly, can set an investor up for multiple tiers of BRRRRs over the next 5 and 10 years. That's a product where I have a lot of control. I know the density and data and provincial response to the density mandate is clear over the last 10 years. And I can position a property to purchase today, turn it into a duplex, hang on to that for 3 years, refinance it again, put in a third unit, rinse and repeat, and have multiple tiers of BRRRRs. And that's really what it was all mapped out in a data-driven format, but that's really the heart of the presentation that I was giving. Is one of these properties can produce significant cash flow on a monthly basis, right? Like net profit on a monthly basis and good net worth. Simply 4 properties can put you right around 10, 12,000 per month and around 2 and 3 million in net worth in 8, 9 years. And so again, be aggressive, but be patient. I think a lot of investors hear 8, 9 years and they're like, where I was anchored to is I would love a perfect BRRRR today. Where can I get that? It's like, okay, I understand that. I understand the desire. However, I would be very careful for investors in our area of the world, especially, to chase perfect BRRRRs as the success criteria. Look in the 5 and 10 year time frame, and you'll find a lot simpler models to achieve that success criteria. And again, 10, 12,000 in income replacement, 2, 3 million in net worth is life-changing for a lot of investors. And such a small operation, right? 4 buildings, 12 doors, a very small operation to own and maintain for all of that reward in a relatively short time frame. I think it's far too overlooked for a lot of investors.
I agree. So when you see control over that asset, obviously that means adding more value, maybe adding another income suite. Are you looking at, when you're doing the consultation with your clients, are you looking at these properties as a strategy, whether it's lot size, whether it's zoning, whether it's, adding another unit as another property in a sense? Like, is that what you're looking at as well when you talk to these clients about helping plan that wealth building journey when it comes to one?
Yeah, so I've had I've had the good fortune to do a number of different strategies. So I just want to contextualize what roughly what that consultation process looks like. So first, understand their goals, and second, I would draw from experience across wholesaling and flipping, RTOs, student rentals, changing singles to doubles and triples and quads, Bill 23, and also apartment buildings. So that's really from my firsthand experience, that's a suite of strategies that I'm looking across, and then really trying to match their goals, which includes financial and pure mathematical, for example, financial, lifestyle goals, risk tolerance, their propensity to do renovations, meaning I do all forced appreciation. That does not mean it's the right fit for another investor, for example. So there's turnkey solutions that might not be as strong as forced appreciation, but still extremely strong. So that's the context, right? So I'm a big believer, and this is why I'm emphasizing this. I'm a big believer in, just because I'm doing it does not mean it's the right thing for me to advise them to do. And that's super important for anybody who's coaching or consulting. I feel like that's very critical. Now, to get into what you were just asking, what are these, what am I talking about when I say control? So for me, when I look at changing a single family home into a duplex or a third unit, fourth, that's an example of control for me. So I have this freehold detached building, my single family home. And when I purchase properly, so what am I looking at? I'm looking at zoning, square footage, egress, parking, ceiling heights, conservation areas. I'm looking at all of these variables, and there's lots to be said around each of those. But when it checks all those boxes, well, now I have a ton of control. I have a ton of latitude. If I buy in the right zoned areas, well, as of right, I have the ability to put in now a second unit, third unit, fourth unit, sometimes five, meaning I don't have to go to a committee of adjustments to get permission to do these things. I don't have to solicit feedback from the neighbors in order to get permission to go ahead and do it. The province has already paved the way for me to go ahead and do that. And so that positions me to buy an asset today, a single family home, and then have the control on timing that works for me, the investor, have the control to add in more units as I go and force up the value. So I get, we look at the last 150 years of data in real estate. It's very, very, very predictable, right? As predictable as you can get in terms of extrapolating forward and saying, are we going to see the average purchase price raise up 7.08%? Well, we've seen that in the last 60 years in the GTA. So the answer is most likely yes, right? And now I add in, so that's the natural appreciation. Now I add in forced appreciation and that control aspect of Bill 23. And that's what really gives me that extra leg up to maintain a strong and fruitful investment while external variables are changing and ebbing and flowing, which they inevitably do. Does that answer your question?
It does. It almost seems like you're using that to safeguard the buffers against the market changes going up and down and fluctuating.
Yeah.
And you're also creating a long-term play with the property. You could do one thing and then another zoning goes in your favor. You could do another. Can you tell us a little bit more about Bill 23? Not too much, but just enough that someone can understand if this could be something that they could use as a strategy and how it could help someone investing in real estate.
Yeah, absolutely. So Bill 23 is the last bill that was passed on a provincial basis, just allowing investors to add more density on the province's behalf. So just a quick context on this. The province has been doing this since 2012, adding the ability for the everyday investor, right, to help with the housing crisis, essentially, is what's going on. And so what do we see? We see the Golden Horseshoe being the recipient of a large percentage of Canadian immigration on an annual basis. Mm-hmm. We see the immigration numbers projected to go up year over year over year consistently. So we've got this influx of demand, right? An ever increasing influx of demand year over year, which is super important. The province is responding to this by saying, we don't want sprawl. Sprawl is not good for us. It means more garbage collection, more sewers, more parks on a broader basis, ultimately leading to less tax dollars per square foot. So the province is, I think, doing a very smart thing and saying we would rather density than sprawl. So, okay, we've got a lot of immigration, very desirable place to live, and we're allowing a lot of immigration, encouraging a lot of immigration. Now, what do we do? Because we don't want sprawl, we want density. Well, let's put control in the everyday investors' hands. So let's take the mom and pop investors, people who own 1, 2, maybe 4 properties, and allow them to buy a single family home and add in a second, third, and fourth unit without any development fees. So for your listeners, that's important. If I buy a plot of land and I build a 4-plex, well, I'm going to have anywhere between 15 and 25,000 in development fees, depending on the municipality per unit, right? So that's a ton of money. That changes my financials significantly. So again, this is one of those areas that a lot of investors think, well, I duplex the place, I'd love to do development. Careful, it's a different animal, right? So this provincial mandate of Bill 23 is the latest in a long string of provincial mandates to the municipalities within Ontario to allow for the everyday investor to implement more units per home, i.e. more density, on a very effective, cost-effective basis, meaning I can retrofit a second suite within the main home and do it with no development fees. So my renovation costs are relatively low. And the Bill 23, again, the latest in the string of provincial mandates, is allowing now not just 2 units, which has been going on since 2012, but now 3 and 4 and sometimes 5 units. So for the everyday investor, now I can position myself to have a ton of control over this property by adding units, either all in one shot up front, which is fine, more capital, more effort up front to do it that way, or what I'm recommending to a lot of investors based on their capital and risk tolerance is do it in stages, on your timing while you go, and save capital up front, let the process iron itself out because it's still relatively new, and do it that way, and then let the refi in 3 years fund the next unit, right? So way less capital today, but also less capital when you do it.
So you help, that's really great. So you almost help them with the process of that planning. Okay, you get to buy this property, this is kind of what it's going to be used for, and we're going to be able to use that forced appreciation as well as the increase in value in the pay down to fund the next refi or the next
Yeah.
increase in density, maybe another unit being added. So that seems like definitely a lot of control for the everyday investor. Like you said, it prevents sprawl, helps the community. It's something municipalities helping with the housing situation and more demand for rental units. Who is this not for? I mean, it seems like everybody, I mean, you said it's not everybody should be doing it, but what should people consider, maybe having a conversation with you, creating a plan? When should they consider in servicing that new debt, for example, taking the money out to to expand in a sense? What are your thoughts on that?
Yeah. So, I mean, who would it not be for? That's a great question, right? So, as strong as the strategy is, and I think it's one of those strategies that almost all investors should, one, educate themselves on, and two, at least gather information so that if nothing else, they rule it out and say this is not right for me. So who would be an example of the probably the less common case of somebody saying, hey, this isn't a good fit, or me saying, oh, look, I don't think this fits you? Capital can be a factor for sure. As soon as you add in a second unit, there's a shorter term capital requirement there in order to fund that renovation. Now, when you do a good BRRRR, a good buy, refi, buy, rental, refi, rent, then you're going to get some of that. Perfect BRRRR is getting all of your capital back, obviously, but you're going to get some of it back. And if you're not, it begs the question of why you're doing the renovation, just buy a turnkey, right? And so capital is part of part of the assessment there. The other one is, I would say, just a psychological readiness almost. Meaning, when I describe this and the potential, there's, for some investors, the renos can scare them. The unknown of what is it? What are you even talking about when you say a second and third unit? This is too new, and it's the burden of education, the burden of familiarity almost is a bit too high. It's all a bit much. I would rather something far more straightforward, and there is no wrong answer there. If the investor's telling me that, or I'm sensing that's 100% the way that is and what we should work with. And so for that investor, at the end of the day, conceptually it's straightforward. It is going to take some work, and if it's not a good fit from a psychological readiness standpoint, it's not the right thing to do, because it'll all feel like a big burden, right? Rather than an opportunity, it'll feel like it's a round hole, square peg kind of thing, just not a good fit. And then the other one is proximity. And so geographic proximity to the market that you're working in is not the end all and be all. I mean, you can do remote operations. I just caution people against it. I caution people when they're looking at it, because it's a non-trivial variable to overcome, especially for new investors. So if you're not near a market where Bill 23 and doing this multiple phase BRRRR is a good fit, well, I would say, look, maybe we should look into some other strategies.
So it almost seems like it's a more effective strategy, gives you more control. It's encouraged by the government, and also, instead of the sort of the shiny object or the pre-con, for example, you're chasing those big returns, quote unquote, the big lift of 400 grand where it doesn't happen.
Yeah.
This seems like it allows you to actually provide more housing, but provide more control. And then those units are actually also not under rent control as well, which I think is a huge win for an investor, their net worth and the situation in general. So that's really, really good. So as far as what you're dealing with now, are you finding a lot of people are starting to take advantage of this? They're taking their equity out, they're doing this, and when they're doing this, for example, we had a situation where a client was looking to get all his money back, and we did a scenario where it was about, I think, $800,000 all in. He'd get 600,000 back from the lift of the property from a single to a triplex conversion. But
Mhm.
what are you finding right now when people are doing this? Should they consider, are there perfect burrs out there, or are they just, is it good to get some of their money back and be able to, increase value and increase that generational wealth component? What do you think about that part?
Yeah. So, I mean, I think there's a few things. So, one of the things I did to help investors really get clear, again, clarity and focus being such critical pieces, and not making macro decisions from micro data. So, as I have consulted with, and educated for a bunch of years now, one of the tools that I developed to be able to offer investors is a 21-page report, a custom built report that takes into account their capital, their financing terms, and really it's a flexible model to be able to. So I mentioned Bill 23, the two extremes. You could put in 5 units on day one, you could wait 10 years and put in 5 units then, or you can stagger them in whatever way makes most sense for you and your risk tolerance, your capital availability, your financing. The model that I built, the 21-page report and the framework that generates it, is flexible enough to accommodate the two extremes and anything else in between, right? And so what is the purpose of a report like that? Well, there's a few different goals to that report. Ultimately, though, it's to step back out of the details and make our best strategic decisions for what fits this investor, and on what timing, right? And so back to your question, what am I seeing out there in terms of burrs and a percentage of capital back? And again, the report is designed to make sure that people are making macro decisions from macro data, and that's the report helps you do that. Meaning, in today's market, some of the best markets that are out there today, because of the interest rates, the primary markets are not quite as strong. The tertiary markets don't make quite as much sense just because the price point isn't low enough relative to the secondary markets. When you look in the secondary markets, and there's more to be said around the definition of those three categories that I'm describing, but in the secondary markets, as an investor looks at it, a lot are scared away by the interest rates rate. Today, what about the interest rates? What about the debt service on my line of credit, my home equity line of credit, where I'm pulling from to fund this? And really, if you self-fund your line of credit and you look across that broader 5-10 year time frame with Bill 23 and all of the control that gives you, the interest rates of today, well, maybe it changes your LTV. Maybe you self-fund the line of credit to offset the debt service and not really impact your monthly disposable income. And when you do those things, one or two or three of those variables to accommodate for the higher interest rates today, then you position that asset for pure upside in the next 5 and 10 years. And the conditions of today really become not an insignificant detail, but far more of a detail than a governing deciding factor.
Yeah.
That's really the key to building a report like this, so you can get clear and say, how do I position this today? When should I add my third and fourth unit, which isn't the same for everybody, by the way? And then what's it really going to allow me to achieve in 9 or 10 years? And I think for a lot of investors, that's really important. It's not enough to me just to say real estate strong, go buy it, right? It's true, but be careful, because you want to do it right in order to get there as quick as you can. And these strategic kind of financial models allow investors to see with clarity, not as a guarantee, but from a probability standpoint, from a pure historical data and extrapolating forward standpoint, this is most likely where I'm going to end up. And so I don't need to be distracted by this, that, and the other thing while I go through my 5 and 10 years. I can stay on course, stay focused, course correct where I need to, because that's inevitable. But it's going to put a rudder on the ship so that I'm course correcting rather than zigzagging all over the place.
Right. Chasing strategies.
Yeah.
Yeah, it seems like it provides a holistic approach, and it actually is like the definition of making macro decisions, big decisions on investing on micro data. So looking at the market, the trends that you've come up with, and specific to that investor and their risk tolerance and their capital, helping them map out how and when they could potentially add more units based on the properties they have or they're going to acquire. Is that right?
Yeah, exactly. Exactly. Although you mix those terms. So it's
Yeah.
macro decisions from
Macro
macro
decisions
data,
on
but
macro
I know
data.
what you meant. Yeah,
No,
for sure.
perfect, perfect. That's
Yeah.
exactly it, right? That's that's we're here to get educated. So when we find people that want to do too much at the beginning, so they want to get this bird, like all their money out, and it's cash flowing amazing, and this primary market or Kitchener-Waterloo or your market area. Um, do you recommend then when they have the report to look at the micro data or the information about the market over the time and be patient rather than expect that perfect burnout or they won't do it? Does that make sense? Like, does that help them overcome that hurdle and not making decision, or it has to be perfect to do that burr?
Yeah, 100%. It's what it does is it de-emphasizes. So what can happen is the conditions of today can eclipse the rest of the picture. And what the report does for you is gives you a 5-10 year view, which which puts the variables of today back into the proper place where they belong, which is relevant, but not necessarily your decision makers. And so it really, that's really conceptually what it does is it changes the emphasis of where is my mind, where is my emphasis, what am I thinking most about? And the conditions of today really are again relevant, but not the governors of this big macro decision of, is this a good investment for me to make today? And will I be happy with this in 5 and 10 years from now? Will I thank myself for having done this? And, back to that study of 89, that was the key, right? Is, the person who buys at the peak makes more money in 15 years. But the real kind of cautionary tale there is if you're not clear and cutting through the noise and getting to the data, the real cautionary tale is, well, I'm going to wait 6 years and not buy investment properties. And then I could easily wait another, 1, 2, 3, 4 years while the market's correcting, coming out of that slump of 89. And in a heartbeat, I could lose 5 or 10 years of my investing lifespan and not really be investing because I'm worried too much about the details of today rather than looking at a broader picture of 5 or 10 years and saying, is this a good investment? Will I be happy I bought this in 5 or 10 years? That's really the more cautionary tale is, you don't have many 10-year sections in your life to waste when it comes to long-term strategies that build a ton of wealth.
That definitely makes a lot of sense. It almost puts in the planning and allows them to cut through the noise because they can look at it granular and they can make a plan that's custom for them, their goals, and not chasing strategies, not
Yeah.
expecting the perfect strategy right away, but also building wealth over time. And like you said, the old adage, especially that you used a lot of the data in the report. So if someone wants to have a conversation with you about their portfolio, maybe they want to invest and they want to get a custom report, we can obviously help them with that. Where can they go to get that? We'll make sure that they're taken care of.
Yeah, perfect. Best place to go is shebib.com, my last name. So shebib.com. That is essentially my link tree that'll get you to anything that I'm kind of focused on and involved in. Or you can go to blueorchardpropertygroup.com and book a consultation in either one of those locations. So either one is a good place to start.
Okay, excellent. So they can get a location. Well, we got about a minute or two. I really thank you for your time. It's been a ton of knowledge. We'll definitely have to have a conversation again. What are some key success factors for investors that you want to leave, or anything you'd like to leave with our audience today?
Yeah, I mean, I think probably the number one thing, especially today, it's true always, at least in my opinion, but especially today, is work on mindset. And that's, I know that's a big broad term, mindset, but it's one of the most critical pieces. So why do I think that's extra important today? Because there's a lot of fear out there. There's a lot of distraction. There's a lot of, I think, misinterpretation of how to respond is the best way I can think to say that. How do I respond to what's going on? And you could ask yourself, when's the best time to respond with fear? Well, probably never,
Yeah.
right? Short of being attacked by a tiger or something and just needing to run out of fear. Well, as strategic investors, responding with a fear response or anything close to that is going to produce a suboptimal return, right? And probably suboptimal decision making. So mindset, I think, especially today, and remember, right, like trees don't grow big, strong roots with no wind. And so we're seeing substantial wins out there today in adversity. But this is where we double down on the fundamental principles, where we double down on grit and resolve and strength of character and fortitude. And we think clearly, despite what might be going on out there, because that's what'll help us. And if your answer is no, that's totally good too. But cut through all that, make a good decision, and work on your mindset and all of those characteristics so that you can decide with clarity, do I want to do this, and will I thank myself in the next 5 or 10 years? And that's really the key, right? And if the answer is no, well, of course, there'll be other things that will be a better fit. But for a lot of investors, again, I think the key is gather the information, assess it well so that you can, as the saying goes, be accountable to your future self. What you don't want to do is kind of be reactionary, and then your future self looks back and says, oh, shoot, I wish I'd have made a better decision. That's really the heart of why mindset's so important.
I love that. Well, Chris, I really, really appreciate your time. It's been incredible. It seems like that's going to help them through weather any storms and have the clarity to not make those mistakes and have the rudder, like you said, to course correct and have a great strategy. So thanks for being on. Really appreciate lots of great knowledge for our listeners today and myself. So thanks again.
Yeah, awesome. Thank you, Sam.
Thanks, Chris. Take care, man.
All right.